Paying for a car has become increasingly difficult for many Americans. Borrowers are falling behind on payments at a rate not seen since 1994. So how did we get here? And what does it mean for anyone looking to buy? Let's rewind to 2020. The federal government had just slashed interest rates to zero, and by 2021, just under 3% of borrowers were past due on their loans. But a lot has changed since then. Interest rates are on the rise, and average car prices are close to an all-time high.
A few years ago, there were a dozen new car models that sold for less than $20,000, but today there's just one model, and the average used car price is now $27,000, up 30% from pre-pandemic levels, with more drivers falling behind on their payments.
Car prices are high and interest rates keep rising, so it's challenging for consumers to come up with these big monthly payments.
Now, more than 6% of borrowers are at least 60 days past due on their subprime auto loans, which are loans issued to borrowers with below average credit scores. And relief for those in debt may still be a long ways off. As the Federal Reserve predicts, higher interest rates will continue through 2026. The problem is magnified for those with bad credit, facing new vehicle loan rates upwards of 20% according to Bankrate.
What we've noticed, especially here in the last 45 days with the Federal Reserve raising rates, that at least 50% of our customers are having payments over $1,000 a month. When you include sales tax and sometimes property tax, it's even more than that.
Edmunds, an automotive inventory and information resource, reported more than 1 in 6 people who financed a vehicle in the second quarter of 2023 have a monthly payment of $1,000 or more, a new record height. So the average new car payment is up by almost 40% over the past 5 years. A vehicle affordability index found the total median weeks of income needed to purchase the average new vehicle now stands at over 42 weeks, close to 1 year's worth of pay.
It is no secret that vehicles have become unaffordable over the last 2 years. In fact, I would argue that they are very close, if not at all-time high prices.
It's a situation that's deteriorating rapidly. As recently as August, industry experts said while the current state of car loan delinquencies was concerning, it had not yet become a cause for alarm.
They're up a little bit, but I don't think they're up to the point of it being alarming.
The growing fear from analysts, if borrowers continue to fall behind on payments, could signal an economic bubble is ready to burst. Margaret Rowe, senior director at Fitch Ratings, said the trends of subprime borrowers can often be the first indication of, quote, where we start to see the negative effects of macroeconomic headwinds. The housing market crash of the late 2000s was driven by subprime borrowers being unable to keep up on their mortgage payments. Further fueling fears, the auto market may be driving toward a similar result.